Zero DTE options, they're some of the more esoteric options I've seen out there in a sense of how risky they are. Not so much every single day, but accumulated over time. Hey, everybody, welcome to another Study Wealth podcast. I'm Serge Berger. I'm your host. I hope you guys are all doing well as we head into July here. Obviously, the month of July tends to be more of a vacation month on both sides of the pond. It's anybody's guess what happens intra-month. The month of July for risk assets tends to hold up, but I suspect there's an above average chance that this year, July, could start to see some volatility, not the least of which has to do with options, specifically zero DTE options. So what we are going to do today is we are going to talk a little bit about these zero DTE options, specifically what they are, what some of the risks are, and what the benefits are, right? Be fair. And so what has happened over the past few months, I've received a lot of different questions around zero DTE, and I, of course, been addressing them as we went through the past few months, through the past couple of quarters. But I shied away from doing a broader podcast because I just really thought that I wanted to get specifically some questions answered that people, or like what people's concerns or not concerns are, right? So let's just go through a few things here. And I think at the end of this, everyone should have a decent idea of what they are. If you are an absolute zero DTE pro, if you understand everything from the Vega effects to the theta effects to the correlation models at complex hedge funds, this is probably not going to be for you. But if you're anyone aside from that, like anyone just a touch below an absolute quant that's dedicated to this, I think this should be worth your while. So first of all, let's understand what zero DTE options are. Zero DTE stands for 0 days to expiration. And even if you're not an options trader, by the way, or not involved in options at all, I think it's worth, I'm sure it's worth understanding what these things are, because they do come with risk for the broader market, like for your portfolio, even if you don't use options. Zero DTE options, essentially, they refer to options contracts that have essentially a lifespan remaining of about 0 days. So basically they expire on the same day that they are traded. So if today is a Tuesday, these are options that turn into existence on Tuesday morning, and then basically are no longer by the end of the day. The zero DTE options have actually always existed, but if you think about it, so if you're at an option expiration day on a Friday and options expire, whether it's a monthly option or a weekly option or a quarterly option, like at some point on that Friday, you will have a 0 days to expiration option inevitably, right? So so they've always existed, but what happened in about the middle part of 2022, we started to see the exchanges decide that they're also going to start offering options expiring on Tuesdays and Thursdays. Options were introduced over a number of years ago that expire on Monday and Wednesday, and of course Friday expirations we've had for a long time, particularly the monthly ones, of course, on the third week of the month of expiration. But once they started adding Tuesday and Thursday expiry options, that is when volume absolutely exploded. And I'm just going to, for those people that are watching this on YouTube, I'm just going to really quickly show you one chart. Again, it doesn't matter if you're watching this on YouTube or not, or listening to the more broad. I'm just going to describe this chart. It's just as fine. So you're not missing anything if you are not on YouTube. So let me just quickly share the screen just for 1 second, because I think this is worthwhile. So what you'll see here and what I'm going to describe here is essentially the volume of options exploding literally around the midpoint of 2022. At this point here, about a year ago. And again, for those people watching on YouTube, what you should be able to see hopefully here on your screen, and if you don't see it, again, not so bad, is just the complete explosion of S&P 500 short-dated options volume as a percentage of total volume. So very simply, for those people that are just listening, the only thing you need to know is that we've gone from short-dated options being a percentage of about, let's say, not quite 20 to 25% of total volume, basically from 2020 to 21, going to basically doubling in a matter of a couple of quarters. Before that, and we didn't have to go back very far. Like we have to go back to 2017 only, where short dated options as a percentage of total options volume only made up less than 10%. So to me, and I have actually not done this, so maybe if someone wants to do this and send me the chart or let me know of the chart, I think this would be a fun exercise. See if you can overlay a chart of stimulus, like basically COVID stimulus, with the explosion of options volume. And I would argue it's probably 1-for-1. The introduction of weekly options, zero DTE options, having coincided with the crazy stimulus, everyone at home, COVID lockdown, everyone's trading options, is like the perfect example. And it's correlated to basically, I'm going to call it money supply. I know someone who's technically an expert in that's going to push back on this, but money in the system, stimulus in some shape or form. I think it's more or less 1-for-1. So keep that in mind. Now, a few more points. Let's just move down the line. And I'm just going to keep this chart up here just for those people that are watching. If you're not, again, it doesn't matter. I'm just going to refer to it every once in a while in words. I think that these options, from what I can tell from the people I talk to, are essentially primarily utilized by very active day traders and speculators who are looking to take advantage of short-term price movements in the underlying asset. However, so this could be very aggressive traders. However, I'll tell you, I also see a lot of investment advisors. So as you guys know, we have a company called Blue Marlin Advisors, in addition to, of course, having the publishing company, thesteadytrader.com. And so I get to talk to lots of our peers. And so think about an investment advisor, like an RI, a registered investment advisor, who's supposed to take care of your money and manage it and be your sort of fiduciary for your financial life. Imagine one of those wants to go further out in the risk curve, and in this case, a lot further out in the risk curve. And they want to say, look, I would like to make another few percent return on my clients' portfolios per year by basically making a bet that an option that I'm going to sell this morning and is going to expire worthless at the end of the day. So there's a lot of even an investment advisor, and not like and these are more asset allocators turned traders over the past few years. They haven't done that for very long, at least the ones I've seen. So I'm not quite sure they know what they're doing, but the risks, which we'll talk about in a minute, are something that they're certainly overlooking. Otherwise, they wouldn't be doing this, or they wouldn't be doing it to the extent that they're doing it. The big question to me that I think everyone needs to be aware of, and again, these are all straight questions that I've collected over the past, about 4 or 5 months at this point, that have come from clients, from followers, from readers, listeners, whatever you want to call it. And one of the questions was, is the zero DTE, or is it primarily people buying options like for speculative moves, or is it people selling options? And what I'm finding is that, yes, there are people buying zero DTE, of course, because they think that they're going to make a fortune by making a direct bet that day. And listen, you can do that. It's just very risky. And again, I'll talk about the risks in a minute, but I'm finding a lot of people actually short these options. If they are short these options, what actually ends up happening is that they are compressing volatility in the equity market. So the VIX just the other day went out on the week at on a Thursday, below 13 and below 14 on the week. Considering where we are in the economic cycle, to me, that's pretty crazy. And so it brings up the question, when does this all end? What I can tell you, and I think there's literally a 100% chance of this. It's not 50, it's not 70 or 80 or 90. It's 100% chance that this will, at some point, and probably several points, lead to massive volatility spikes in the market. Like the VIX goes from, current example, let's say from 14, 15 to 30 in 2 days or less. And that is going to blow up a lot of portfolios. Before we enhance on that a little bit more, just understand that the zero DTE trading, the investment advisors and individual traders, we run a service called Credit Spread Authority, where we basically do options credit spreads as a trade alert service. And we actually manage that same portfolio at Blue Marlin Advisors for our clients. So it exists as a trade alert service at the Steady Trader, but we actually manage that professionally at Blue Marlin Advisors. And by the way, shameless plug, we've averaged about 30% per year. I think we're up 17 or 18 or more percent year to date, something like that. Anyway, I'm done with the shameless plug. And so all these people are selling options. And even in our chat room, there's a little subgroup that I see turning to quite a big subgroup that is doing this stuff. And I warn them once a month. I put a note in there. And in fact, every day, I think actually I made him put a note in there that this is risky stuff. It doesn't reflect what we subscribe to. By all means, do it until it stops working if you want to and you feel comfortable with the risks. However, again, if people are selling options, so you're selling an option, let's say it's 50 cents, you receive 50 cents or $50 per contract, and you're making a bet that because it's going to expire by the end of the day worthless, you will be able to keep that entire 50 cents. Or maybe you buy it back for 5 cents at the end of the day. So you made 45 cents, i.e. $45 per contract. Do that with 10 contracts, you make $450. You do it with 20 contracts, you make $900, so on and so forth, right? So that's what's happening. And it's suppressing volatility at a point where even though economic data itself, headline stuff, doesn't look as bad as at least some of the stuff that the bulls look at, underneath the surface, things are awful. Like I keep coming across worse and worse statistics about how badly various generations are doing, paycheck to paycheck, credit card debt skyrocketing. But a few people, probably many of you listening here, are not yet feeling it all that badly. But it's happening underneath the surface. And so zero DTE options are going to are literally that ball that's being pushed underneath the water. And there's many other, we can use the other example that I think resonates with people is like a coiled spring. You push the string together, or you pull a rubber band at some point, it snaps back, right? All any of those will do. It's the same thing. That's people selling options. Let's talk for a minute about people buying options and what the effect is. So there are people out there who are buying zero DTE options, right? So they're buying very short dated options and in the hopes of getting a move right. What happens from a market maker's perspective, and I think this is really important for people to understand, is buying speculation begets essentially more speculation indirectly. So if myself, as an example, if I were to go out and buy a call, it doesn't matter what expiration, by the way, it's just even more exacerbated with zero DTE. But if I were to buy a call option, the dealer, the market maker, JP Morgan, whoever, Citadel, whatever, they are selling me that call. So they're selling me the right that I can buy that stock at a certain point for a certain price. Meaning if the stock goes up and I bought a 50 strike call and it goes to 60, I have the right to buy the stock at 55. The dealer, however, has to hedge himself or herself. And the way the dealer does that is by actually perversely going out there and buying stock, because he doesn't want to take the risk of having to buy stock at a much higher price just to sell it to me for a much lower price. So he buys the stock. So in case the stock goes up, he will at least break even on that trade in the sense that has made money on the gain of the stock. So then he takes the profits and sells it for me the other price. And of course, he's short the option as well. So anyway, long story short, what happens is people buying calls, particularly if it's very speculative, which is with 100%, like zero DTE, there is some argument that for dealers, this is a more effective way to hedge themselves. And I don't disagree with that, obviously. And I am not a pro on the dealer side, just to be clear, that's another level. But the speculative efforts beget more buying, right? So let's say in an extreme example, NVIDIA, if I wanted to buy a call on NVIDIA, the dealer has to go out there and buy stock, right, to hedge himself. So buying begets more buying, and you can see how this can very quickly turn into a very risky thing, because as soon as we get an outside volatility event, these options are going to blow everyone's book up. And I'll get to that in a minute. Let me just blow through a couple more questions. Essentially, zero DT options, if you want to sum it up, they're based on a principle of capturing immediate price fluctuations, right? So this is not at all, has nothing to do with tomorrow, has nothing to do with the day after tomorrow or next week. It's today. So you have to get today right. And we know how hard that is. So traders typically use them to capitalize on the intraday volatility and thus basically hopefully profit from a rapid market movement. And so that's the risk, the bet they're making. But due to the extremely short lifespan, the zero DTE options, they are very high risk. And what I'm seeing is they should be favored by a lot of really experienced traders. What I am seeing, though, more and more, is that a lot of people who really are not experienced, who may have traded options for a while but don't really understand them, are doing them. And that includes investment advisors that I talk to that really are not professional options people, even though they're investment advisors. They're just not doing it because everyone else is doing it. So there's various strategies one can use with zero DTE, including scalping, momentum trading, hedging, all sorts of stuff. Mostly it's being done for speculative stuff, whether it's buying the options or selling them, either way, right? This is the risk I want to make everyone aware of. I alluded to it a little bit before. The biggest risk to me is that we are going to get a flash crash that lasts a number of days, maybe a week. So the people I've been speaking with over the past 3-4 months now to really get my head around zero DTE are telling me, and I didn't need them to tell me that, I knew that part, but I'll get to the other stuff. I think it's going to be very difficult to have a 1987 crash. Like, I think the market was down 20+% in that day because we have these circuit breakers. So the market would basically shut down for the day if it's limit down, right? A couple times or some 2-3 times, whatever the limit down is. Like that happened, for example, during 9/11 when they reopened the markets. Anyway, so I don't think that's possible. But what is possible is that we have a whole series of days, and I'm going to bring up another chart. And again, I'll talk to this. So if you're not watching this on YouTube, do not worry. It's not going to affect you. I'm going to describe it just as well. But I think there is a real risk of one day we have a volatility shock. What's a volatility shock? It's some really bad news hitting the tape, whatever that news is, economic, corporate, God forbid, geopolitical of some sort, and it just catches everyone flat-footed. And it will happen. It's, again, it is not an if, it's a when. I'm 100% convinced of that it will happen. I just don't know when it's going to happen, but it can happen any day now is basically my thinking. It doesn't mean it will happen any day now. I'm just saying that's kind of the mindset I'm in. So then what's going to happen is the S&P would be, let's say, down 5%. And I don't know where the first circuit breakers come in, if it's 3 or 5, I don't know, or 10. I didn't even know. I have to look it up. So this, my bad. I should have educated myself in that. But you'll get an S&P down 3-4% in a heartbeat. The circuit breakers then come in. And then what happens, and this is where it gets a little bit technical, and I'm going to try to keep this really simple without going into too much detail. What ends up happening, because everyone's so short-dated focused, the entire volatility spectrum changes. When you're trading a zero DT option, you're looking for a market in a range. And if it starts blowing out way out of that range, you get a completely different market than what you had before. So now everyone that was in these options or has a book of these options, and they may be weekly options or a zero D, doesn't really matter, or some rolling kind of thing where they roll every day or every week, it's going to blow their book apart. And so they're going to get out of all positions. They're going to get margin calls, by the way. And you know what that means? Margin calls are going to have to sell stock. So then the reverse happens to what I said before. So if people are speculatively buying calls, the dealer has to hedge themselves, right? So that the buying begets more buying. But on the other hand, when we start getting out of this and people, and again, the market shifts and everyone has to once to get out at the same time. Remember, it's the small door example, right? Not, you can only so many people fit through a door at any given moment. What then is going to happen is you're going to see forced selling. So not only do people want to sell, they're also forced to sell because of margin calls. That could be something like where the S&P literally in a matter of a couple days could easily, and this wouldn't even really register, but it could be down 8, 9, 10%. So as I'm recording, this would be where the S&P was, like, for example, in March of this year. So basically giving up a large chunk of the rally. And then, of course, what's going to happen, because we have such a crazy market structure where, and I don't have it here right now, but something like, anyway, you guys know how I don't want to give you numbers, I don't want to be misquoted here. But the NVIDIAs and Apple, $1 trillion company, market cap. How many people do you think own Nvidia and Apple? A lot. How many people think that people are sitting on Nvidia and Apple on profits? Yeah, plenty of people are, because they've gone up. How many people think that when you get a margin call, those might be some of the stocks they sell because they can sell them, A, because of liquidity, and B, because they're sitting on profits in those stocks? So then what's going to happen is all those stocks, they're so heavily weighted in the market, they're going to come crashing down. And I don't mean like they're not going to fall like 80%, but they could very quickly fall 15, 20, 30%. That's not a big deal. NVIDIA fell 65% in 2022. That's not because it's a bad company, but these are market technicalities that can happen. So just like on the upside, call buying begets more buying, bullish activity begets more bullish. Everyone's gotten bullish. A lot of my institutional friends have gotten bullish now over the past month because they capitulated. They had to do some quarter end window dressing and all that fun stuff. I would argue at the wrong time, but whatever. We'll find out in hindsight, of course. The same thing's going to happen on the downside, except much, much quicker. So NVIDIA, and this is not a forecast, but I'm just saying, like, NVIDIA could fill its gap, its up gap that it had on May 24th. And from right now, right here, where I'm recording this, just to fill that gap at 300-ish, that's 25, 26% from here. And that would be a perfectly fine move. That's just mean reversion for NVIDIA. That would be healthy, but it's going to shock the living daylights out of the market. So I'm trying to show you here today what the risks are of something like a 0DTE. And I don't want to badmouth them too much, but I do see, and I see this empirically, this is not based on academic studies I'm reading that Goldman Sachs read. I see the kind of people that are doing this. They're either, like I said, investment advisors that are selling options, whereby they are artificially suppressing volatility, right? And these guys are not options pros, not the people that I know, right? Those guys are not options pros. They know options, but they're not absolute pros. So I don't think they understand what can really happen to their book if things go the wrong way. And also, I'm seeing lots of individuals using these options as complete speculation. They might be selling them, they might be buying them, and they definitely don't have the levels of sophistication of a quantitative trader at a major hedge fund, right? So I don't think a lot of people are really truly aware of the risks that are embedded here. In the meantime, it's going to be fine. The problem is with this kind of a thing, it doesn't give you a lot of warning until it blows up. So I'm trying to tread a sort of a fine line here. I don't want to badmouth CRTD too badly, although I know I'm obviously doing it. But I think it's fine innovation. The problem with 0DTE I have more is the kind of people that are using those options. And the reason why they're using for complete greed, being unaware of the real risks at a point in time that is really not well suited for this for these to be used. Of course, it's difficult to get people to change their mind because they just made a lot of money over the past couple of quarters, probably, or at least the past quarter or so with this. So until they start losing money, it's difficult for them to get to listen. The problem, and this is where one thing where I do get people to listen on this, is I try to explain to them that markets take the elevator up, the escalator up, and the elevator down. The same thing is for P&L, like their profit and loss. So it might take Johnny, trader XYZ, let's say 6 months to make a $10,000 gain. Just random number, random name, whatever. It's just an idea. But he could lose those $10,000, and that's a lot of work. He's proud. He worked hard. He did risk management 6 months. Everything's great. Those $10,000 could evaporate in a matter of 1 or 2 days. So then the question is, how is Johnny going to feel? Is he going to be happy about that? He's not going to be happy. Is he going to be devastated and maybe potentially he bought something on a margin, like a house or a car or something, because he was making all this money now and now he lost it all again in 2 days? So you see there too, snowball effects that can happen, right? Anyway, folks, I hope this is helpful. And over at Blue Marlin Advice, our investment advisory firm, we really focus on risk management. It's our number one goal, is to educate our client base that there's a time to be more aggressive in investing and trading, and there's a time to be more careful. And as much as we've had a big rally here, our analysis of the broad market does not suggest that the next 6 months in the market here in 2023, as I'm recording this here at the midway point of the year, is going to be anything like the first half. I know a lot of linear thinkers at certainly central banks, but also some of the large private banks that are have to stick to certain models and please the investment banking relationships. They have more linear forecasts. Oh, tech stocks are going to continue to be the great thing in the second half. And they may be right. The odds are that they're not going to be right. And again, we're looking, in short, let me sum it up. The zero DTE options, the way they're being used right now, they're not bad instruments in and of themselves. It's just that the wrong people are using them at the wrong time right now for the wrong reasons. Zero DTE options, the current situation is that it risks, and again, I think there's a 100% chance likelihood that is going to lead to major volatility shocks. Again, VIX going to 15 to 30 in a matter of a day or two, the S&P down 10, 15% in a matter of a few days is absolutely possible. www.steadywealthpodcast.com is where you can listen to this. Also up on YouTube. That's all embedded on the steadywealthpodcast.com. If you are interested in trading and investing research, trade alert software, go on over to the steadytrader.com. So that's www.thestudytrader.com. If you are interested in money management, investment advisory, like where we talk to you, we actually give you investment recommendations, trading recommendations. If we have a relationship with you, we can call you. And that's bluemarlinadvisors.com. So you go to www.bluemarlinadvisor, singular, advisor.com. The company is called Blue Marlin Advisors. The website is bluemarlinadvisor.com. Thanks so much for listening, folks. I'll see you again in the next Steady Wealth podcast. Until then, be well and exercise risk management in the markets. Take care.